Good afternoon. Happy Friday. This is Sean LaBelle of the Dekker Hewett Group. It was a negative week here for global equities as we officially close off a very weak month of April. There wasn't necessarily anything moving markets this week. We did have a continued rollout of earnings, which are coming in a little bit mixed. A lot of companies are doing quite well, but there is a bit of concern around forward guidance as a lot of companies are highlighting inflationary concerns in terms of labor and input costs. There's also the continued concern around supply chains and bottlenecks. There's a lot of companies that are now highlighting FX headwinds, and by this, they mean that the strength of the US dollar is offsetting international revenues right now. The US dollar has been stubbornly high here of late. If you look at the Dixie, this is just a basket of currencies. It's trading over 100 for the first time in a long time. This just shows that the US dollar is quite strong relative to other major global currencies. So in terms of this week's Market Watch Weekly, we jump into that US 10-year, which continues to hover with rates around 3%. This, of course, is the rate that a lot of investors are concerned about in terms of whether it's going to be causing an inflationary environment. So there's a really interesting chart in there that just looks at the last 6 or 7 recessions that we've seen going back to the 70s. The average 10-year rate for those recessionary environments was around 8%. So 3% is obviously a long way off from that. We don't think we're going to get 8% in this cycle. In fact, we can almost guarantee that. But it does weigh in on investor sentiment because, again, this is the highest level that we've seen in a number of years now. So this week's Market Watch Weekly just runs through that a little bit. It's also heavy on our chief market strategist, US Tony Dwyer. He finds there's a lot of comparisons with this broader climate right now with that of 1994, where the US Fed at the time was Alan Greenspan, unexpectedly became a little bit more hawkish and did drive up the interest rates rather quickly. There's a big difference between now and then, though, is that the FOMC and the US Fed, they do openly state now what their intentions are with respect to interest rates. Back then, there was no communication. They just acted. So anyways, this week's Market Watch Weekly is an interesting one to read because it does allude to 1994 as a very interesting period to compare. Of course, that was not a recessionary environment. And despite a lot of intra-year volatility, stocks did fare quite well, and nor did the market or the economy enter a recession in 1995 and onwards. So we encourage you guys to take a read. Hope everyone enjoys the weekend, and we will talk to you again next week. Cheers.